Hey traders, this is Blake Morrow with Trader Summit, and I feel so happy. I have Mr. Marc Chandler with Bannockburn Forex here with us. How are you doing, Mark?
Good. Happy summer.
Happy? Is it summer? Are we still in summer? It feels like summer doldrums, doesn't it, in the markets a little?
Yeah.
So, hey, why is it that volatility is so low? I mean, I know there's a lot of fireworks happening probably from like the next 24 hours on, but why are things so in the doldrums right now?
Yeah, I mean, it's kind of interesting. I think that we've sort of reached I don't know if I want to say equilibrium, but we've reached sort of this balance now. I think that markets hesitant to take moves before the central bank meetings. And we're also like in no man's land. We're in between like the US jobs data and the next CPI report. I should say we're in between the CPI and the next jobs report in early October. And so I think that people have extended positions. You can see this at the in the futures market, and there's been some strong trends. The euro has been falling since the middle of July, and when it peaked, I was there. I was thinking that we're in for another sort of normal correction in this uptrend that we've had since the end of last September. And instead of just being a normal correction, it seems like it's lasted a lot longer. These 9 weeks is the longest decline the euro's had in its history. And I think you have to go back, if you look at a synthetic, you have to go back to like the mid 90s to see something this long, the European currency. So the trends are very extended. Dollar yen's trading at the highs for the year still. So I think people are a bit nervous. They know that they're tempting the central banks, and there's a lot of data and central bank meetings ahead of us.
Mark, this is a lot of people feel this is it. I mean, the euro has found a level where we're going to start to see some lows, because the dollar, people are going to start looking at the Fed and thinking, oh, well, the Fed's pretty much done hiking rates. As you said, we said this, before we hit record, but we were talking about, what central bank may do. But I think the market is anticipating they're not going to do anything. And then by the time we get to November, the data is going to be a little softer. So the Feds might be done. So maybe the dollar has peaked here. But do you think that this really big move lower that we've seen in the euro over the last, as you pointed out, 9 weeks, do you think there's more to go?
Yeah, so I was thinking that, I'm sort of believing that they keep it simple, stupid, the KISS method when it comes to like trying to understand the price patterns so I kind of thought that there's potential to maybe even down to 106. If we go much below 106, I think we got to look at 104. There's some people out there that economists, the Institute for International Finance, for example, talking about fair value for the euro being closer to 90 cents. And I don't see that. For me, I'd say the euro is terribly undervalued now. We all have to develop our own tools and techniques to figure out what valuation means in the world of fiat. And that is to say that, my crypto friends are right. Dollar is not backed by gold or silver. So how do we know where the currency is overvalued or undervalued? And so I use this the OECD's model of purchasing power parity. You probably know about purchasing power parity, like the Economist magazine looks at the Big Mac or Starbucks cappuccinos. And it's sort of interesting, I find, like just intellectually, that I was watching these mixed martial fights the other night on TV, and they said that this one small guy was stronger pound for pound than one of these big guys. It doesn't mean that the small guy can take on and win against one of these big guys, but it's that if the small guy was as big as the big guy, he could. And I think in currencies, we do the same thing. That's what purchasing power parity means. PPP, it's almost like pound for pound. And so the euro and the yen are more than 50% undervalued by this model. And the value of this kind of model is that I'm not looking at the latest shiny thing and saying, oh, this is the new valuation model. This is something that's been around for a long time. And the euro and the yen now are cheaper and purchasing power parity terms than they were, say, in 1985, when there was the Plaza Agreement to drive them higher and drive the dollar lower. And so, of course, the euro did exist. I'm just converting it from the Deutschmark. But you get the idea that, at least from this model of valuation, the dollar is very, very expensive. And what this means for someone, we're thinking about our personal accounts. For me, it means I need to be diversifying my 401k, which is of course heavily weighted towards U.S. stocks. My career, everything we have is in the U.S. And so for me, I think that dollar-based investors are well served, diversifying, taking advantage of the strong dollar to diversify. You've already seen, I don't know, that famous guy from Omaha buying Japanese brokers or Japanese companies. And I think that we see this also in other flows. Americans buying more Japanese stocks. I think Europe still has the news from Europe is bad. Of course, it's poor, and of course the war is there. Still maybe haven't overcome the energy shock. So I sort of see from the flows data that I can look at. So it says that more Americans are buying Japanese equities, Japanese bonds than buying European. I'll tell you what I recently did, and it sort of works on the same basis. And this might not be for everybody, but I sort of thought that the risk reward was there. So what I was looking at was saying that, okay, what's the strongest emerging market has been Mexico, leaving aside Russia. And the peso has just been very strong. And of course, most foreign investors don't really seem to like the Mexican president, AMLO. But I was just looking at his budget a couple of weeks ago. We announced this budget, and he's going to give Pemex, their like state-owned or state-run oil company, enough money to service a good part of their dollar debt next year. And so I decided to buy a Pemex bond that expires in April of 2025. So I have about a year and a half or so on it, paying 8%.
Wow.
And it's a dollar bond, so I'm not taking any currency exposure. I'm taking basically Mexico's credit rating or Pemex's credit rating with the help of the government, thinking that how can I lock in fixed income at a relatively attractive rate for the next year or so. And I like this idea. I like the idea that I've sort of tried to benefit from Mexico's budget. AMLO had a very tight-fisted during COVID, and now that next year's election's approaching, not that he can run, but he wants to make sure that his party can win. And so he's got an expansion fiscal budget, very expansionary fiscal. And so I sort of thought, if he's going to give money to Pemex, maybe I could get my little cut of it.
There you go. Well, that's one way to take advantage of it. Mark, it's funny. I could sit here and talk to you all day because I know we wanted to have a few discussions about China, but really quick, and we're going to see how this conversation goes. But I want to start with the central banks this week. We starting tomorrow, we have the Fed, and then we're going to have many other G10 central banks. What are your thoughts about the Fed and the other central banks that are meeting this week?
Yeah, sure. So the Fed, of course, is the most interesting for most of us. It still drives a lot of the capital markets. I think I sort of buy into the what I think is the consensus view now, a hawkish hold. That is oftentimes if we talk about central banks, I say, watch what they do, not so much what they say. But it's different, I think, this week with the Federal Reserve. I think they're not going to do anything, but we should watch what they say. And what I expect them to say is a few things that give it this hawkish tilt. One is they're not going to rule out another rate hike this year. They said in June they'd hike rates twice. They delivered one of those. And so I think they want to keep that door open. Secondly, I think they revised up GDP. Their forecast for GDP, the median was 1% in June. I think they could go up to, I think 1.5% is conservative. I think 2% is more likely. So revise up GDP, revise down unemployment a little bit because it's much lower than they thought it would be. They might even tweak core PCE deflator down. And I think that the last kicker for this hawkish hold is that rather than in June, they said they'd cut rates 4 times next year. And I can see them saying, well, maybe only 3 times. So net, I think it's going to be a hawkish hold. I think it's too early to rule out another hike from the Fed this year. I sort of still lean a little bit towards November. I know people are concerned about the UAW strike and the possibility that the government closes in early October. But I think that these are what I would call the known unknowns for the Fed. And I don't think they can really factor them into their forecasts, partly because whatever they are going to be short-lived phenomenon. Whether it's the strike, even if the strike lasts a couple of weeks, we're talking about the Federal Reserve who's making forecasts on an annual basis. And so I'd say these are concerns, the UAW strike which looks like it's going to extend if there's no resolution shortly. If there's no progress, it'll extend again on Friday. And of course, this strange fiscal policies in the U.S. that could lead to a partial government shutdown. Both of these would be, of course, headwinds for the economy.
How about the student loan repayments? Do you think that's going to be a concern for consumers moving forward?
I think so. I think this is why I'm getting more and more pessimistic about Q4. We're going to have, it looks like we're going to have a decent, to say, call it close to 3%, 3.5% Q3 GDP. But I just think a lot of these headwinds, and student loans would be among them. Even if it only takes off a little bit off of consumption. Remember, consumption is roughly 70% of the economy. And at first, I think that just to have to resume the debt servicing cuts it in half or so, and we're already slowing down on the consumption side, it seemed like. So yeah, so I'm concerned about these things. The other thing, of course, is the higher oil prices, higher gasoline prices. I think they were behind the gains that we saw in CPI, PPI, and retail sales, because remember, the way U.S. reports retail sales is just like dollar value, nominal value, rather than volume. And so basically higher energy prices already filtering through. And I think that as they continue to do so, I know many people think that higher oil prices, higher gasoline prices, this is inflation. But I really think that that's not the best way to view it. I think the best way to view it is maybe in the first instant it lifts prices, like I mentioned, CPI, PPI, but ultimately it's a brake, it's a tax on consumption. And because the more, basically, the more it costs us to heat our house or cool our house or drive our car, the less money we have for other things. And those other things are services we're not buying. So reduce demand for those. And it translates softer prices relative to energy.
Yeah, that's interesting, and to see how it's going to affect consumer prices. I've been talking amongst our community about the rise in crude, and there's a level, and you never know where it's at in crude and in gas and energy, where it starts to really affect the consumer, where it becomes more of a negative for risk. And I think this rally in crude oil above 90 is probably going to start, maybe one of the factors that's starting to weigh on risk appetite is at current prices. So yeah. No, Mark, you believe the Fed is going to give us a hawkish hold, but how about the Bank of England? It looks like they're going to raise rates, but how dovish are they going to be? I mean, you got a country that's really struggling from a growth point of view, right?
No, I think you're right. I think that the problem is that the central banks have to demonstrate, I think they have to demonstrate their anti-inflation resolve. And so that means to overlook the weakness of the economy and even a renewed risk of a contraction in the UK economy. So I think they're going to hike rates 25 basis points. The market's got it nearly priced in. A few weeks ago, the market was thinking that there was a small chance of a 50 basis point hike. They've shaved that back. They're not even fully there at a 25 basis point, but close. I think that the two other issues I think are going to be more important for how the markets respond. One is if there's any clue for another hike. The market's about 50-50 for another hike in Q4. And the other thing that the Bank of England could do, and I would expect them to do, is to speed up their quantitative tightening. And remember that quantitative tightening, letting the balance sheet unwind, sort of giving back, as instruments mature, not to recycle them into new investments. And so I think there's scope for, they're at 80 billion a month now. I can see that going to 90, maybe even 100 billion a month. And also they're going to be done unwinding their corporate bonds that they bought. And so, I would look for the Bank of England. I think the Bank of England is probably the most likely out of the six central banks, six G10 central banks that meet. I have the Bank of England as the most likely to hike and the most likely to accelerate their QT. Try to be, so I'd say it's a hawkish hike in that sense.
Which would be interesting because the sterling has been under such pressure. I mean, we've been below the 200-day moving average. It doesn't seem like it doesn't matter what happens and what data comes out. The pound is trading, well, we're well below 124 right now, but even below 125. I mean, maybe they'll give some bulls some relief there.
Yeah, I don't know. I'm still concerned. For me, I'm looking at a chart, the chart patterns. I sort of think that there's a head and shoulders was carved out and it opens up to possibly even 120. And then I think about where we were last September. At the end of last September, not quite a full year ago. We still have another week or so, but this is the sort of the anniversary of the crisis that took sterling down to a record low, about 103.50 or so. So we've come quite a long distance. I mean, think that we rallied almost 30 cents from the lows, and this is when sort of the conventional wisdom was that the UK was an emerging market country. The Economist magazine had an article calling it brittly. And so I'm like I do the same thing that I think that traders do, and that is I'm looking at the retracements from those lows and thinking that okay, we had a big bounce, a big recovery from perhaps unreasonably low levels, and then what kind of retracement? Where are we in the retracement? And we haven't even retraced that minimum, let's say 38.2% retracement in sterling, but we have for sure in the euro.
Mark, I want to point out to people that are tuning in right now that don't know this. You were one of the only people to come up to me and say, look, that low was taken out in Asia. That's not a real low. This thing's going to bounce. And we bounced like a bat out of hell. So, yeah.
No, thanks. But, I find that this is why I really admire what you and your team do is that it's one thing to have these ideas, and then it's really where it's sort of like how it's executed is the difference between making money and losing money on these things. And so I think it's a different skill set to know like where to put a stop. It's one thing to say, yeah, sterling's overdone, but it's another thing where to get in, how to put a stop, how to manage the trade. And I think that's another set of skills that most people I know are fortunate to have either one or the other. Few people I know really have both.
Well, we appreciate that. We definitely love to trade and figure out the best executions around. So, hey, Mark, I know there's a couple other central banks. I do want to talk about the BOJ, but we also have the Riksbank and we have the Norges Central Bank. Any ideas on those two?
Yeah, so I think Sweden's in a tough position, sort of like how you described the UK, a weakening economy, and for them, it's a house prices have really like collapsed. I want to say off 20% or more, but I think that Sweden. So what Sweden and Norway do is the central bank sort of gives us the path that they anticipate policy to be on, a policy path. Both central banks, Sweden and Norway, signaled at their last meeting they're likely to hike rates in September. I believe Sweden. But I think that I'm not as confident that Norway will be able to wants to raise rates. Sweden, partly it's really where inflation is from both countries, and so I think even though the Norwegian krone has been relatively weak, I think that it's not so important for them. The economy is also weak, and I think that's why they're not. I think that's why if I had to wager on which one, I'd say Sweden most likely to hike 25, Norway less likely to hike. It could, but I think people would feel more confident that if Norway does hike, it's the last hike. And we saw that. So how the markets respond, like last week when the ECB hiked rates, the market thinks it's the last hike. They sold off the euro, and I think that works the same way. I think for the UK, if they don't keep that door open for another hike, sterling will sell off. And if they don't raise rates out of a sort of a surprise move, if they don't hike rates, I think the currency sells off. Same thing for Sweden. Also in Europe, before we leave that, is Switzerland. I think that many people look for the Swiss. I think that Bloomberg median forecast is for economists expect the Swiss to hike. The market, though, the swap market doesn't have it priced in. And I kind of agree with the market over the economists on this. The euro is still very weak against the Swiss franc, which is to say the Swiss franc is very strong against the euro. Inflation is falling. And so I don't really see a compelling need for the Swiss to hike rates. And I think that by not hiking rates, maybe they can get some relief on their own very strong currency. And lastly, let me just quickly add about the Bank of Japan.
Yes.
That meets as well as, of course, and the focus has been on the yield curve control, but I think that's shifting. I think that the BOJ governor, Ueda, had said that essentially that he'll have enough data by the end of the year to decide about lifting the negative policy rate minus 10 basis points. And so I think the focus will be on So I think that the Bank of Japan would love to have the same thing the Fed has, a hawkish hold rates, but scare the market enough or give the market enough reason to believe that you can hike rates before the end of the year. The yield curve control, they doubled the band from 25 to 50 at the end of last year. They doubled it again in July from 50 to 100. And today we got up to about 72 basis points. So I don't think that there's any need to change that upper band until it gets pressed against. I mean, my preference, of course, would be for officials to do something before the limit is approached. But the officials tend to be slow about these things, and they don't move until they have to.
That's interesting that you say that. So in your view, then the dollar yen could definitely make a move for 150.
Yeah, so I'm concerned that when you look back at what the Japanese did last year, when they intervened, the last time they intervened, October 21 of last year. And the reason I know that date is because at the same date that U.S. 10-year yields peaked, or it peaked for like 6 or 7 months. So I wouldn't rule out intervention, but I think it's hard to make the case right now that the yen is either volatile or that it's a yen story rather than a broad U.S. dollar-based story.
Mark, you said at the very beginning of our discussion today that on a PPP or that valuation, that the yen and the euro are undervalued on purchasing power parity. Would you use a move above 150 to get long some yen?
Yeah, I like that idea. I mean, so what I've been trying to do is slowly buy some Japanese stocks, even though ultimately I think that the currency, of course, when you think about how it's supposed to work, is that if you have a basket of international stocks, the currency swings could be about a third of your total return. But if you have a basket of bonds, the currency could be 2/3 of your return. So on the idea, so the premise that the yen is very weak, it's better to buy fixed income in Japan. But I don't really have much of a way to do that or much of an appetite for that kind of fixed income, even though I get the currency gain. But so I am looking at Japanese stocks, and there's a lot of different Japanese stock funds out there, as well as Japanese companies that trade on an ADR basis in the U.S. I think that so I have to think about which sector, small caps or big caps, will benefit from a pushback down, a recovery of the yen, pushed down in the dollar. And I kind of think it would be the large exporting multinational companies as opposed to the small caps. And so that's really what I've been focusing on in Japan. But I think the other message here, and maybe this gets us into a little bit about the China story, is when it comes to retail, when it comes to like my money or my friends, we think about what asset can we buy that's going to go up in price. But I know that on an institutional side, that's not what they think about. That's not how they think about it, because they use OPM, other people's money. So the institutions don't just buy an asset, but they fund it with something. And they fund it in this case, we talk about a carry trade, which means being short like the yen and buying some of the higher yielding or higher volatile asset like emerging markets or the S&Ps or U.S. Treasuries. Or maybe just on a currency play. One has worked out very well this year, of course, say is short yen along Mexican peso or along Brazil, where you pick up the interest rate and maybe get some spot movement in your favor. I think that with the yen at these kind of levels, though, it's kind of scary to keep using it as a funding currency because one morning we could wake up and the BOJ could have intervened while we were sleeping.
Yeah.
And so what I sort of see as a what's the next step, and I think that has already been taking place, and that is that instead of using the yen as your funding currency, as a short leg of your trade, using CNH, which is a Chinese offshore currency. And the reason to do that is a couple of things. One is that they have very low interest rates. And perhaps even, I mean, we'll see perhaps as early as tomorrow whether the banks cut the prime rates.
For the 1 and 5 year, right?
1 and 5 year, yep, they're set more by banks, who didn't really pass on the full cut that the central bank gave in that 1 year medium term lending facility last month. So there's maybe a little bit of like room for them to cut rates, but the idea is that the yen and the RMB trade very close together. By that I mean 60% of the time or so they move in the same direction over, say, the last 100 days. And so rather than using the yen, which I say the BOJ has climbed up that intervention ladder without having material intervention, but just the words that they use, China's trying to stop the yuan. I think that's trying to, like, I kind of can think of what China's doing is blowing air underneath the parachute as the RMB falls. But I think that might be a more interesting way to play, sort of using the RMB as a funding currency. That's the offshore yuan, the CNH, as a funding currency. But I think when it turns, everything's going to turn together.
Interesting. Well, I'll tell you, the US dollar CNH is backed right up to some key levels where we're approaching a big breakout above like 738, 740. So
yeah, I mean, so what I do is I try to watch where the PBOC sets the dollar's reference rate every day. Because I'm going to call it the fix, because China allows the dollar to move 2% on either side of the fix, and it hardly ever uses that full range of that band. But the offshore market most often respects the band, even though they don't have to. They know that the Chinese officials, they've intervened in the offshore market by tightening liquidity in Hong Kong, making it more difficult to borrow CNH to use it, as I'm suggesting, as a funding currency.
all right. Well, Mark, I'll tell you, I love having conversations with you. I don't do it often enough. But your blog, it's my go-to staple every day. We publish it on Trader Summit. You can get to it, down in the link below. But how do people follow your work that are not familiar on how to do that through Trader Summit?
Yeah, sure. And I really appreciate you posting it. I think that before the internet was as developed as it is now, these standalone sites like my blog, Mark to Market, could hold its own. But I recognize that how I work too, is if you can get me something that aggregates a lot of news together, I'm more likely to go to it than the individual ones. And so that's one of the reasons I appreciate posting it, casting a wider audience. So my blog, Mark to Market, I've had since like 2006. My employers have, one way or the other, they tend to let me keep it. It's got very little advertisement on it. It's just a little plug for Bannockburn, the company that employs me. But I do try to post something 6 days a week. I was posting for many years, every day of the week. Getting older, it's getting harder to do. It's getting harder to maintain people's interest. There's so many other competing places for people to go for information. I think what I bring to the table, besides experience, for whatever that's really worth, ultimately, it's a lot of scar tissue, is trying to combine technicals and the macro fundamentals. I'm like yourself, I'm interested in price action, and so, but I'm also need a story. I need a story, and I think I'm a storyteller trying to link these factoids, creating a narrative that can be tested by the price action, tries to explain the price action, not just describe it, but try to see what's the next step. And I try to keep, I don't even know like what I'm eating for dinner tonight, so that my price, I have long-term views, but I find that if we have long-term views and these big pictures, like the euro could go down to 90 cents, like that IIF says is fair value, that tells me if that's your objective, then your stop is going to be far away. And which means you're going to lose more money on those trades if you're wrong. And so I'd much rather have a play in the shorter run, a couple of days at a time, a week at a time, where my stop is manageable, where my loss is manageable, and even though it might not be the whole move, I can just take a piece of it at a time. And we all have our own like personalities, our own ways of trying to do things. Many ways to like skin the cat. But my way is, even though I do have long-term views, I know that I can really trade only on my short-term ideas.
Well, Mark, I love your ideas, and like I said, it's been a mainstay of mine, for years and years and years, going on a couple of decades. So
Ouch.
I appreciate you. And if you are listening to this interview, make sure you give Mark a big thumbs up, subscribe to the channel down below so you don't miss any of this exclusive content. Mark, love having you here. Thank you so much for spending your time with the Trader Summit community. We really appreciate you.
Thanks, Blake. Much appreciated.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.